welcome everybody. I'm seeing everybody joining right now, so we'll get started in just a second here. I see Solange is with us as well. Hello, Solange.
Hi.
So glad you could make it with us today, of course, as well. Lots of exciting things to talk about. All right, so why don't we get kicked off? So as a start, first off, you are joining today Human Capital Disclosure on the board. This is an extremely hot topic. Solange, as you'll talk about in a few minutes here as we get started, you'll be able to explain even further about how hot a topic this is right now, and not only why people are asking so much about this and boards are searching for human capital experts, but also what that means and how it benefits these organizations that are truly leveraging this. So human capital disclosure on the board and preparing your organization for human capital reporting. All of this is mixed into our discussion today. Know that for those joining that have their International Board Director Competency Designation, you'll also receive your 1 CPE credit by attending today. So welcome everybody. Few things to get us started. Know that the purpose today is to share knowledge and trending on the meaning, importance, and disclosure of human capital elements, and also their importance to the board. So Solange, I know you'll make a lot of those correlations to not just the board, but senior leadership and really organizations as a whole. Write your questions in the Q&A section. Our goal is always to answer all these questions at the close of today's presentation. And for those that have asked questions in the past that we haven't gotten to, you know already that we follow up with emails on those. So both I as well as Solange commit to answering those if we don't get to those during the session today. Materials, somebody always asks this, or multiple times, so I usually address this right in the beginning. Yes, the entire webinar is being recorded. You'll receive a link to this by email within a day or two after the webinar ends today. And that link will also include the ability to view and download the presentation deck in a separate file. So you'll get both of the access to both of those through a link that I'll send out shortly after the webinar in the next day or two. Also, many of these webinars have additional aspects that we just can't get into within the hour. So you'll see references or additional reference links on many of the pages. If you want to delve deeper into some of these concepts or read articles from either Solange or myself, you'll be able to click on those once you receive the separate presentation file at the close of the webinar also. All right. So with that, Solange, you look ready. Let's kick off, and exciting.
I was born ready.
I'm glad to hear that. All right. So quick intro for Solange. Solange, our paths have crossed now. I think we originally met, as we stated earlier, in June of 2014, and been involved in a few different things. We've worked together on a few different areas. So pleasure to have you back with the organization today. So Dr. Charas is a pioneering data scientist and expert in human capital metrics. She has been CHRO for public companies and serves as a board director for public, private, nonprofit, and higher education organizations as well. You must know something if higher education organizations are chasing you, Solange. And Solange is also a human capital consultant, an adjunct professor at Columbia, USC, and NYU, and also a distinguished principal research fellow at the Conference Board. So congratulations to all those accomplishments, Solange.
Thank you.
Quick background on me. I'm a governance and strategy expert, a board director, board consultant. I've consulted with hundreds of private, public, and nonprofit boards. I'm known as the board architect. And I always talk about my book. You'll see in the background here across the board, The Modern Architecture Behind an Effective Board of Directors. So with all of that, Solange, let's kick off. Let me go through our path for today so everybody kind of knows where we're going, what we'd like you to walk away with from today's webinar. So first off, this question I get a lot in the boardroom. Solange, you probably hear this a lot as well. What's the difference between human resources and human capital? We're going to talk about that. We want to show you the main differences and the importance of thinking about those differently. The importance of human capital just as a whole. What does it mean? What does this mean for my organization or for your organization? What are the disclosure requirements now? And a couple of interesting and very recent examples of, I think we're going to talk about one organization that didn't do this correctly, and the SEC is on them right now because they didn't disclose material aspects of human capital. And then Solange, very much appreciated you provided an in-depth view of Bank of America as an example of the correlation of human capital and how that's elevated both internal and external to the organization in their operations and what they do. And I would assume the perception and the optics are affected by that as well, which I know you'll get into today. So excellent, exciting things. All right, let me get you kicked off here, Solange. I wouldn't ask anybody else for the difference between human resources and human capital, because I know this is, you probably dream about these things. So go ahead.
Yeah, there is a difference, and the difference is evolving. So some people think that human capital is really just a fancy word for human resources, but it actually is a different lens through which to look at the organization. And we think about human resources as really something that's inwardly focused. So we think in the old traditional way, what used to be called personnel got the name evolved to human resources, but it's essentially the same thing. It's actually looking at programs within the organization, looking at your skill set, right? The sum total of people, talent that you have working in the organization. It's very budget focused. So, we look at how much we spend on certain programs, and we measure our success of those programs as KPIs, like single program focus. Like, I love it when people tell me, when CHROs tell me, oh, we've got a really effective performance management program in our organization. And I'd say, okay, well, why do you think it's effective? Because our KPI is to have 98% of all employees go through performance management, and we always achieve that goal. So we have a successful performance management program. And I always say, well, all you've done is achieve some type of a participation rate, but that's not telling me the quality of your performance management program. How is that related to attrition or retention or bench strength or upgrading skills and competencies? What about your return on investment? You spend money on that program. How do you understand whether or not you're actually getting a return on investment in your program? So human resources really is inwardly focused, looks at programs. KPIs are indicative of the program itself. And again, we measure based on budgets. That's very different than what we're seeing in terms of human capital. So I don't know if you want me to just
I moved to human
in.
capital. Let's do the segue now to show the difference. Exactly.
Good. So human capital really is something that's outwardly focused. Human capital takes into account how human capital or human resources programs, because we're not going to get rid of human resources programs. We just want to contextualize it differently. So it really looks at how human resource programs are actually supporting enterprise level performance. So instead of doing a human resources program, measuring its impact based on the program, we measure the impact based on how well the enterprise is doing, or how well it is supporting other KPIs for HR programs. So for example, I talked about before, is your training and development actually generating, we can look at how many people go through the program, but we also have to look at whether or not that training and development protocol was effective in enhancing the skills, competencies, and capabilities of the human capital, the talent of the organization, but also whether or not it's actually supporting the strategic goals, commercial goals, or strategic goals of the enterprise. So we're now beginning to connect the dots between human capital programs or human resource programs and corporate level performance.
I think that has been one of the biggest challenges you described there, Solange, which is what is that evolution of HR and the areas that we've looked at historically only inwardly and now focusing outwardly, which is really where the value of the organization or the view of the value of the organization is housed.
Right. It's catching on, right? And I say that it's catching on because for the last 30 years, we've been studying this in the academic community, starting with, Becker, Huselid, Podsakoff, all of these human capital researchers, back then, they didn't call it human capital, human resources researchers have actually been opining and studying the impact of human capital as an input to the business model on business outcomes. And it's catching on now in the practitioner's world. It's had a lot of help, right? We've had people pushing from the outside to get people to look at the link between human capital performance and corporate financial performance. But that's the new focus.
Great. And that's a perfect foundation for things we're going to talk about that actually build off of this foundation of human capital in this new viewpoint, and how that correlates back to multiple areas, not just value of the organization, but even satisfaction of employees. And we're going to talk about some of those disclosure points. Perfect.
And you bring up a really good point. If you go back to the prior slide, you really bring up a good point that we can't measure these programs in silos. Right? We can't measure a program in the absence of its impact because it is a system. And, more and more we understand how organizations or enterprises are systems. And we can't just unplug one piece and expect the rest of the organization to function. We're seeing that with ESG. We're seeing that with, the evolution of business models. And for human capital, the focus isn't on KPIs necessarily. The focus is on return on investment in those programs. So we've got a new dimension to think about when we think about human capital programs.
Great. And maybe that's again a perfect segue into what do we actually mean when we talk about the measurement areas or the areas of focus. This particular letter I had found that was submitted by the Human Capital Management Coalition to the SEC. And I was interested to know, have there been changes or are there interesting points in these 9 here that you see, or an evolution of these areas since this letter was submitted some time ago?
Yeah. So this letter from the Human Capital Management Coalition was submitted to Jay Clayton at the SEC a while back. Probably maybe 2018.
I think it was, we're going to see that in the listing here of the chronology of events, but I think it was 2016 or 2018.
Yeah, something like that. The Human Capital Management Coalition, just to give you some context, is an organization of a coalition of investors who actually they got together in the late 2000s, like 2008, 2009. It's an organization that has something close to $9 trillion of assets under management. So organizations like CalPERS and CalSTRS, the UAW, I think Coca-Cola is part of the coalition. They actually got together informally. These are people who are investing pension monies. And they said, how do we optimize our return on investment for our pension constituents if we don't really understand the human capital impact on the organization? And, these are organizations that understand that human capital is really important in driving outcomes. And they actually started thinking about how to change their investment model based on the information that they were getting from target investment organizations about human capital. And then they started codifying, right, these things that they were looking at. And you can see in the letter to the SEC, they asked Jay Clayton to amend the disclosure rules for public filers so that companies are actually providing information in these 9 areas that will help the investor community better assess the sustainable long-term prospects of that organization in terms of generating economic value. And they took these 9, and over time, there was a whole process. There was, public forum about it. We're not going to bore you with that. But over time, the HCMC has actually refined what they believe are the minimum types of information that they want to see from all public companies to be able to better assess the viability of an investment in that organization. And the 4 that they came up with now, and I know this because so the people at the HCMC, just a shout out to them, Cambria Allen, Meredith Miller, who's about to retire, and Mary Morris. And I just had a conversation with Mary Morris about this. The 4 that they would really like to see disclosed include workforce stability. So you're actually disclosing information about attrition and retention. Workforce demographics, they want to see diversity, and they want to see categories of diversity at different levels of the organization, from, factory shop worker all the way up to the boardroom. They want to see workforce composition. So what percent of your workforce is full-time, part-time, contingent, gig workers, digital workers? So they really want to understand the unit of labor input to the organization. And most importantly, which I kept for last, is they want to see a financial indicator of the total cost of workforce. How much is the company actually investing in people and people programs in their organization? And right now, there is absolutely no way to know what that is, because the only thing that companies are required from a rules-based perspective to disclose is really the number of employees. And they don't even have to tell you at what time they had those employees. Is at the highest point or at the lowest point of their employee level. So we really don't know anything. And the Human Capital Management Coalition thinks that with these 4 data elements, they will really be able to understand human capital contribution to corporate financial performance.
And that's truly where the transparency lies. So I know we're going to talk in a moment also about the inherent value in many organizations, especially in service type organizations or knowledge space.
Yeah.
Obviously, the people are the resource, right? So I would want to know as an investor or a stakeholder in those organizations exactly what's happening with those resources. That truly would come from, it sounds like Solange, would come from these types of disclosures.
Yeah, absolutely. And we'll get to it in a second, but this is just really scraping the top of the iceberg when it comes to human capital information. The human resources or human capital function is rife with data. It probably has more data than the financial function does. Mm. The difference is in the human capital space, because we have so many siloed functions. HRS is different than performance management, than training and development, than recruitment, than succession planning, than communications. They all live in little silos and they don't share data. And the other problem is there's a conception or a misconception that human capital data is not clean data because people are messy and unpredictable. So how can the data that we get from messy and unpredictable sources actually be reliable and valid? And those are 2 huge misconceptions, that there's no data and that the data isn't good.
Good to know. Thank you. Well, this you may find interesting as well. This was a survey that I conducted in my digital publication in June of last year. And the question very simply was asked, is your board and organization prepared to supply meaningful and detailed human capital disclosure? Now, in June of 2020, I don't think I was personally surprised, having seen this firsthand in boardrooms in my consulting realm, that this was really scaring, probably up there in the level of scaring board members at the same level of cybersecurity, quite frankly, because they didn't know if they were going to be disclosing these. Where did they get the information from? What does it actually mean? Still going back to this difference between human resources and human capital. My question to you, Solange, is what have you seen since then? Has this number hopefully increased in terms of a yes to this answer? What are you seeing in some of the boardrooms and the executive leaders' realms with their comfort level of this disclosure?
Yeah. It's really interesting because your question can actually be parsed. So are they not prepared because they don't have the analytics, or are they not prepared because they don't feel that human capital is material to their organization? So
it probably was a combination of both, but
probably a combination of both.
Yeah.
Exactly. So what we did is we wanted to understand what companies were disclosing and how many companies were disclosing since the November 2020 requirement from the SEC that companies disclose human capital information if they deem it to be material to their organization. So we can have more than an hour's conversation on what materiality means. But we're not going to get into the fine points of it. Let's assume that with organizations that are knowledge-based organizations, professional services firms, right? Service organizations where they really rely on people to deliver goods and services, that human capital is material, right? And we usually think of materiality as, and this is a real rough, and this is not, a FASB, demarcation, but if an organization is spending more than 50% of its total expenses on people, then people are probably material to your organization, right? And and most organizations will spend more than 50%. Most industries spend more than 50% of their operating budgets on people. There are a few exceptions, of course, like real estate investment trusts. They have lots of assets under management and very few employees, but most organizations aren't structured like that. So what we did is we looked at the public company filings starting November of 2020, when the rule went into effect, through the first quarter of 2021. So we captured the first quarter filings in essence. We looked at about 344 or so companies to see what they're disclosing. Are they addressing materiality? And if they address materiality, what are they disclosing? And what we found is more than 50% of those filers were actually disclosing something, right? So majority of the people, of the filers, of the companies, were actually addressing human capital in one way, shape, or form. What we found was twice as many disclosures were qualitative in nature, right? Just to describe a policy or a aspirational perspective, and only 33% of the disclosures were actually quantitative in nature, where they actually gave numbers or gave some type of a metric or an indicator about their human capital. What we did is we actually created a transparency score. So if you provided no disclosure, you got a 0. If you just provided qualitative disclosure, you got a score of 1, you got 1 point. And if you provided quantitative disclosures, you got 2 additional points. So the highest score any individual organization could get, or any organization could get, is about 20 points, because we looked at a bunch of different categories: board diversity, workforce diversity, talent acquisition and deployment, workforce capability, worker health and safety, worker comp, executive comp, culture, engagement, and experience. So, and I know we're going to talk about culture in a second, so let's put a little pin in that.
Absolutely.
So we looked at these 8 sort of categories for human capital disclosure, and we created this overall score. And what we found was, which you're going to probably love, the most prevalent overall disclosure was about COVID impact on employees. Okay, makes sense. The next most prevalent disclosure was around worker comp and benefits. And the third was around talent acquisition and deployment. So that's what's top of mind. Again, only 33% of companies actually provided any numbers, anything quantitative about that. Now, here's the interesting thing. We actually had a representative sample of all industries in these 344 companies. We actually designed it that way so that we can basically generalize to all companies. So every company was appropriately represented. The 4 top disclosing industries were construction, wholesale trade, finance, insurance, and real estate as an industry sector, and retail trade. And you'll see that those organizations are highly dependent on labor.
Yes.
And that's what we found. So really, really interesting. We know that things are going to change, because under Jay Clayton, we had a different reporting regime, right? Jay Clayton was a big fan of principles-based reporting, right? So not all companies have to follow the rules. You disclose if you think it's material. But Gary Gensler, who's the new chairman of the SEC, has a different point of view. And he's not such a big fan of principles-based. He's much more aligned with rules-based, and which means that we anticipate before the end of this year, or maybe at the beginning of next year, we're going to see guidelines that Gensler is going to issue for all public companies to disclose certain human capital indicators, regardless of their size, regardless if human capital is material or not. It's going to be a blanket, you're a filer, you disclose. And we believe that at least the 4 that I highlighted from the HCMC are going to be on that list.
Interesting. So Solange, and we're going to get to this in a moment, we know that the disclosure is based off of the materiality clause or the materiality aspect currently. And your belief is that's going to move further into the requirement to disclose those.
It's going to be rules based, like Sarbanes-Oxley and Dodd-Frank. This new disclosure requirement for human capital is going to be a check the box. Did I disclose on total cost of workforce? Did I disclose on employee, workforce demographic? Did I disclose on workforce composition? And did I disclose on attrition and retention, workforce stability? So it's, even if you have 3 employees, you're going to have to disclose. It's going to be required. And that's going to have a big ripple effect, starting from the boardroom all the way down to the HR function.
Interesting.
So hopefully you'll be ready for that.
That is going to be a big change for many companies, moving from that materiality mindset to the actual required disclosure mindset.
Now, the thing is, you can look at it and say, oh my God, this is a bad thing. Or you can look at it and say, oh my God, this is a great opportunity for us to understand how to better leverage more than 50% of what we spend in our company to make the company go.
Well, absolutely. And it drives the right behaviors internally to the organization. And in addition, as a stakeholder or a shareholder, you're understanding things that are truly material to the organization. And that's a perfect segue, Solange. And thank you for your detail on the background of even in a short amount of time, from June of 2020 to today, we're already seeing these changes. But I think what you're describing is going to drive that even faster. Human capital, along with culture, is estimated to compromise on average greater than 52% of a company's market value. Now, initially, when we hear that, we think, well, of course, it's the people, right? It's coming back to the people. It's coming back to the aspects of the culture of the organization. But as you start to think about this more deeply, you say to yourself, well, even with the wrong leader or a wrong division or the risk at the board level, all of these things play into this value of the company. And I would even think, with your background, you may argue that number is higher. That percentage is higher, I would think.
I would argue that, and it's not just me. It's Ocean Tomo did research going back all the way to 1975. And they found that in 1975, for the S&P 500, only about 25%, I think that's the right number, of a company's market value was made up of intangible assets. And 75% was made up tangible assets, plant, property, equipment, inventories, things that you can count and measure. Fast forward to 2020, the Ocean Tomo did the analysis, and what they found is, again, for the S&P 500, that tangible assets, plant, property, and equipment that used to be 75% of a company's market value now only comprise 10% of a company's market value, and 90% is comprised of intangible assets. Now, what does that mean? That means, look at companies like Google and Amazon and Facebook. Those are companies that are all intangible value, right? And what the SEC did back, and you might be showing a slide in a second about it, the Investor Advisory Committee basically agreed that human capital is not just an expense to an organization, but should be viewed as an investment in an intangible asset. So we're taking human capital from the P&L and actually thinking about how it should be migrated to the balance sheet. Now it'll be on both because we have expenses associated with it. But when we invest in human capital, when we put people through training, right? They are more valuable to us than just their salary that we're paying them. They provide productivity and they provide value. How do we capture that and account for that in our income statements and our balance sheets? And I think that we're going to see like a cottage industry develop, just as what happened when ERISA was passed, right? We didn't have benefits lawyers and benefits accountants before ERISA, but when that legislation was passed, all of a sudden we had to account for a new way of a new item on our balance sheet and our income statement. And I think that we're moving in that direction. And, you know, even though my MBA is in accounting and finance, I simply don't have the brain power to think through what the accounting would look like and how that would impact financial statements, but I predict it's coming. And I bet you if we have a conversation 5 years from now, we're going to be talking about balance sheet and income statement entries for human capital.
Well, mark your calendar, because in 5 years from now, you'll be back doing this webinar again. Quick question, and I'm going to try to rush on a few topics here to keep, I want to make sure we have at least 10, 12 minutes for the Bank of America example. But when we talk about this paradigm shift of the tangible value going to the intangible value, right? It's almost a direct swap. What exactly, and again, 10-second or less answer. I know there's a lot more detail to this, but is that we have more data, we're better at understanding how a workforce works. Is it technology? What fits into that?
It's technology, it's a level of sophistication and understanding the inputs into the business model. We have, we can trend things, we can calculate things, we can analyze things, we can create metrics. Like, how many board directors actually understand the cost of attrition to their organizations? That's like
it's
huge.
Low. Yeah, and it's low.
Huge.
Yeah.
It's a huge impact. Nobody was talking about it because we really didn't understand how to calculate it. We did a lot of a lot of descriptive analytics where we create reports, but we didn't do a lot of diagnostic analytics to actually understand the interactions between things so that we can value employees and the loss of an employee on the economic value creating potential of the organization. So we're just much more sophisticated. We have better technology. We've evolved in terms of our thinking. And we've had to, because our employee populations have changed as well.
That's right.
So organizations have had to respond to the change. Like, I'd be interested to see if anyone in the participants room has not experienced or thought about the implications of what we're experiencing now, which is the Great Resignation, right? Every company is experiencing employees leaving. Why? Because what we're seeing in the research of the Conference Board is that new hires are getting about 15% more in pay than they were getting at the organization that they left. So there's a huge incentive for people to switch companies, which means that for you to gain new employees, you got to raise your rates, your salary rates by about 15%.
The knock-on effect to this, that could be a webinar in itself for this Great Resignation we're talking about. And even my article from this month, how that's correlating now into what I'm calling the great CEO swap out. So with COVID leaving, what's happening with the CEOs now that's maybe have not been performing, but boards did not want to make that change in the interim with everything else going on with COVID. So
and it's
we're
not
going to
just
see a lot of change.
And it's not just CEOs, it's the C-suite.
Absolutely. Absolutely. All right, let me continue here. Solange, I probably needed to make this webinar 2 hours long, quite frankly, with the interesting topics, but we'll do this on time for everybody today.
I'll work on being shorter.
No, it's fine. It's fine. I'll if I'm nudging you, just know that it's in a polite way. So everything you're mentioning supports this comment here, human capital and culture are therefore inextricably linked to creating long-term value. Shouldn't be a secret to anybody, even with someone with a very basic human resources knowledge understands that. But now I think we're looking at the evolution of human resources and another component of that as we correlate that to human capital and its effect on the overall organization. So it wasn't by chance in the US, as my example is here, that the SEC noticed this. They're making some assessments. They agree with the assessments. And my question to you, again, for a quick answer on this so we save enough time for the Bank of America example, is how is this global? Is this a global action that's taking place right now? Is this trickling out from either into the US or outside the US? Is there consolidation in this viewpoint?
Yeah, absolutely. This is not a US only issue. This is a global issue. We've had the luxury really of having enough labor to be able to fill jobs until recently. And so we've thought about human resources really as more of a commodity than a scarce resource that we need to think about and manage. In Europe, they've had a different sort of economic situation. They've been thinking about these issues for much longer than we have, and they're a little further along than we are in their development and level of sophistication. For example, in most companies in Europe, for most companies, they have to disclose their total cost of workforce. So it's not hidden as it is in the United States. The International Standards Organization, under the umbrella of the TC 260 initiative, has been coming out with standards around human capital for the last 10 years. The most recent standard, ISO 3414, is really around human capital governance, right? So in Europe and the other parts of the world, we've been thinking about human capital as a governance issue. It's only in the United States that the only thing that we think about in terms of governance is executive pay, CEO succession. Now, the situation is changing. We've got 10 million open jobs and only 7 million people on unemployment. Even if every person was able to find the right job, the job that they're qualified for, we'd still have a deficit of 3 million people. And so we need to think about this from a governance perspective. We invest money in people, we need to see a return on that, which I'll show you in that B of A example. Great. But the ISO standard is around transparency. They actually call for the calculation of about 54 human capital metrics and the public disclosure of 10. WIDA, which is the Workforce Investment Disclosure Act, which passed the House and is now sitting in the Senate, is actually asking for the amendment of SEC to require public companies disclose on something like 24 metrics. And that's why we think that Gary Gensler is basically going to voluntarily put in guidelines that say disclose on these 4 or 6 or 8, so that we don't have to have legislation that forces us to disclose on 24 metrics. So there are things going on around disclosure and transparency. SASB and IIRC just merged, right? There are lots of governance agencies that are asking for disclosure of human capital information. Each one of those governance monitoring agencies has their own point of view. And what we're seeing now is some harmonization attempts. So the World Economic Forum is now working with all the governance monitoring agencies around standardizing human capital disclosure requirements so that we don't have 30 different standards out there. We've got harmonization so that when you pick up a financial report of a French company and compare it to an American company, you can actually compare apples to apples instead of having all these different standards generate different metrics.
Great.
So it's coming. It's
great
coming.
Background and history on that as well, of how that's it's a shared responsibility, but we are, it sounds like, in the US learning something from some other regions in their reporting. So there's probably some history there and some data we can pull on that as well. Excellent. I'm going to keep moving here. I want to make sure we have enough time for questions as well. I'm just going to do a quick gloss over here of some of the background of how this came to be, and then we're going to move to your example. Just very high level. The SEC Investor Advisory Committee was formed. It advised the Commission on regulatory priorities. This happened in 2009. Following the start of that Investor Advisory Committee within the SEC, in March of 2019. Here's the answer to our question earlier, Solange, on the date at which it was submitted. This new framework was proposed, including numerous human capital reporting and human capital management disclosure metrics, right? That was proposed in 2019. Then we saw in August of 2020, the vote for this new human capital disclosure rule. However, it was based, as we mentioned earlier, on the concept of materiality. So, Solange, based on what I'm hearing from you, it looks like we're in the next evolution of this, where it's likely that either all or some of those components that are considered to be material will move into the realm of being required for disclosure, which is going to be quite interesting to watch. I'll also mention on this, as I think about my entrepreneurial side is kicking in right now. So for those board directors right now that have human resources background, it sounds like it would be a worthwhile investment to get yourself ramped up in the human capital world as well. Sorry, Solange, I'm creating competition for you.
No, it's not competition. We love that. The more people are aware of, human capital analytics and human capital metrics and materiality, and start creating correlations between how human capital contributes to corporate financial performance, the better. We want the whole world to be, and
it supports the common good, absolutely.
Big enough for everybody to have a very nice meal at this table. So
right. Perfect. Supports the common good. So I hear what you're saying.
Common good, exactly.
All right. So I think we're ready. Maybe just you tell me, do you want to spend time on this? You want me to jump right into the Bank of America example?
Let me spend 2 seconds on this and then we can jump in. So as a board director or somebody who is in the governance space that doesn't have a human capital background, you're probably scratching your head going, what am I supposed to do now? So on the prior slide, there was a hot link to a report that we did at the conference board that really talks about human capital management as a board governance issue. So I highly recommend that you download that. That was an 18-month study where we had a lot of participation. We had about 240 experts from all different areas of this topic. Board directors, governance experts, SEC commissioners, lawyers, and investor relations people. We had a lot of input to create that report, so I recommend it highly. In that report, we talk about 5 types of human capital macroeconomic performance indicators. These are indicators of human capital materiality. And you can see we've given you the name, and I didn't make these up. This is from 40 years of academic research because we want to create consistent measures, consistent algorithms. The name of the measure and how you calculate it. So we actually give you the formula. So if you're not an HR person, if you've got a little bit of financial wherewithal, you can absolutely do this on your own. Or here's the unabashed sales pitch. HC Moneyball provides a platform that will do this for you automatically at a fraction of what it would cost you to either hire a consultant or hire a data analyst to your company. Okay, enough selling. But you can calculate this on your own. And we use these indicators, HCROI, human capital return on investment, and the like, I'm not going to read all of them to you, to really monitor over time the performance of the organization in terms of its human capital contribution to economic value creation. Don't do this as a single period, look. You have to look at it over time, right? Do it month by month or quarter by quarter for a year, 2 years, so that you can see your trend. And then benchmark it, which is the other thing our platform provides, is the ability to benchmark your performance to other companies in your SIC code, filtered or not filtered. Okay, so you got the idea that we're actually trying to understand the correlation between human capital performance and corporate financial performance.
Absolutely.
And if you go to the next slide, I can show that.
Solange, I'm going to time you on these. So you're going to get 1 minute per slide, so we have enough time for questions. So go.
This is straight out of the Bank of America Human Capital Management Report 2020. They actually provide this information. What they're showing is that there is a relationship between employee engagement and employee turnover. The more engagement goes up, the less turnover they have in their employees. And we know that turnover is super costly. This was great. Every HR person, this is their dream outcome. But my question was, how did they get there? So in the next slide, what I did is I went to Bank of America's financial statements, and they actually disclose human capital cost in a line called compensation and benefits, or salary and benefits, or personnel costs. Can't remember what their label is, but they actually provide this information, and most financial services companies do provide that granularity of information.
It's interesting to see these together now, though. However, this is a new view. Absolutely.
So what accounts for the fact that their employee engagement is going up? Well, we see that their human capital investment intensity, which is that blue line, and I didn't put a legend on it, that goes from 74 to 76 to 78%, is the percent of expense allocated to human capital of their non-interest operating expense. So we take out their interest expense because that's different. And we see that year over year, they're actually spending more on their people than they were in the prior year from a percent perspective, but also from an absolute perspective. So between 2019 and 2020, they spent an additional $748 million on their employees. And then I calculated the cost savings of going from 11% to 7% attrition using some just standard assumptions. The drop from 11 to 7% saved the organization $1.2 billion.
Wow.
They spent $748 million on people, and they saved $1.2 billion. That's a 63% return on investment. And I promise
I'm assuming that's the materiality.
There's nowhere else in the world you will find a 63% return on investment in 1 year.
Wow.
And that's why Moynihan is so committed to human capital. On the next slide, I actually wanted to understand. So now I'm seeing a relationship between investing in people and getting some positive outcomes, but I wanted to see whether or not it moved the needle on company performance. And so I added total assets, and you can see that their assets went up from 2019 to 2020, even though their expenses went up on people, right? So a CFO will think, oh, if I want my profits to go up or I want my assets to go up, I have to cut my expenses. In this instance, they actually spent more on people and they got a positive outcome. What I calculated is that $748 million investment turned out to be a 2% per person, per employee increase. Their assets grew 13% per person.
Wow.
So there's another indicator of how human capital, investing in human capital, actually drives corporate performance. Again, I challenge you to find an investment that gives you a 7.5% return in 1 year. Or sorry, 6.5% return in 1 year. I mean,
and quite frankly, this is some of the data that investors will make those decisions based on, Solange. So absolutely why it's important.
Now, the last slide. And I think I'm sticking within my 1 minute per slide.
I'm policing you. Go ahead.
Okay, good. It's not good enough to see what the organization is doing. As an investor, I want to do a comparative analysis. So I looked at Bank of America's 5 identified competitors: Morgan Stanley, Merrill Lynch, Wells Fargo, JP Morgan Chase, and Goldman Sachs. And they all disclose the same data. And I just ran the analytics. I just did the same metrics analytics that I did for Bank of America. You can see I added the HCROI, and you can see that Bank of America outperforms return on investment on every human capital dollar spent over their competitor, except for 2020. There's probably something going on in there, but on average, they spend more on their employees on average than the competitors do, 78% versus 66%. But wow, take a look at how big their asset differential is. So there is a rationale for Bank of America to invest the way they do in their employees, as long as they continue to get positive outcomes from it. And that's what I think the investor community wants to see. And this is the kind of analysis that I think the boardroom should see when they start making decisions about budget allocations and how they're going to reshape their business models. They need to think about whether or not they're getting a return on investment in their single largest line item expense. So
Solange, this is great to see it in this format. This brings the financial component to not just the doing good and doing right, but there is a incentive to do this. So
yeah,
excellent,
absolutely.
excellent viewpoint. I'm
And it
hoping you
also,
continue with this throughout the years also to track it even further.
yeah, and what's interesting is right now, most executive comp plans do not have a human capital metric indicator in it. And when that is the thing, especially in financial services, healthcare, companies that use a lot of human capital, professional services firms, how can you not overlook human capital performance as an executive compensation indicator? So I think it's not only about informing, budget decisions, but I think it's going to also inform compensation decisions.
Absolutely. Excellent. This makes everything real. So when you see the numbers and the comparisons, this is really where everything makes sense on this. Thank you so much, Solange. And let me go here. So I just want to mention quickly, Solange, you have your human capital materiality calculator. For when those on this webinar receive this deck along with the video in the next day or so, you'll be able to click on this link here and use this. So I was playing around with this yesterday. Quite interesting. Thank you for offering this up to the audience today.
Yeah, really easy to use. All you need is 4 pieces of information. And then you can figure out, there you go. Those are the 4. Revenues, expense, EBITDA, the cost of human capital as a percent of operating expense. And then you can play with number 5 with that slide rule to see if I can improve my human capital efficiency, how does that impact my bottom line performance? And it's all calculated for you right there. So you can actually see how small changes in human capital performance generate big, big changes in profitability performance for public companies and budget, achievement in nonprofit organizations.
We may have a few people in this audience today, Solange, that when they do this, they may have a sleepless weekend after calculating this. But yeah. Excellent, and I the value's there to see how this works. Excellent, thank you. All right, most of the folks today, I think, on this webinar already know about the education and certification course. If you're interested, the link is here. Let's move on to questions. We have a few minutes left for this. Let me see. One of these here is a comment. I guess it started out as a question and it's a comment. This is why I'm seeing more requests for human capital expertise on boards. It has answered that question. Okay, so I would agree with that.
Yeah.
Do you expect to see a large increase in litigation related to HC disclosure? For example, the Blizzard Activision example.
Yeah, great question. I'm sorry, I meant to address that. The reaction, the first response, especially from GCs that are advising boards, is let's keep our disclosures around human capital to a minimum. Better to not say as much as we should say, just to manage that risk. But what we saw with the Activision Blizzard example is that their lack of disclosure around human capital materiality and issues around that, what was going on in the company, has actually led to an SEC investigation. So this is really showing you not only how serious the SEC is about this, but that you have an obligation to disclose what is material. What happened with Activision is they've had an EEO investigation in their organization for the last 3 years around 3 different issues. A couple of them are class action. And they failed to report that the EEOC has been in their organization investigating for 3 years. And the settlement was coming that was actually material. And I don't know what they were thinking, that they could just bury this, sweep it under the carpet.
I think you'd want to know about this as an investor.
You would want to know. And that's exactly why the SEC is going after them. So, the less is more, less is better argument around disclosures is not necessarily holding true, at least in this first example of the SEC pursuing under disclosure around human capital.
Mm-hmm. Great. And I'll tell you, it's probably a joint article for us in the making right now with this Blizzard Activision when we see how this settles out as it relates to the human capital disclosure areas. I think for me, one of the interesting points is what do we consider? What's that line between disclosure as material and not. Sometimes it's very easy to see, but there are areas where they're not as black and white as we want them to be. So it could be quite an interesting article for us to consider, Solange. All right, another question. Relating to the comparison of employee engagement going up and turnover going down, what type of employee engagement are we talking about? So let me jump back. That was on page 15, I believe, right? So the basis of this question is actually quite interesting. What do we mean by employee engagement? What do you view employee engagement as actually encompassing?
Right. So Bank of America in this report, and again, I'm going to repeat what the name of the report is. It's the Human Capital Management Report 2020. If you Google it, it's right there. They actually do an employee engagement survey in their organization periodically. And this is the result of their employee engagement survey. So do I believe that, I mean, the cynic HR person in me goes, there isn't one organization on the face of the earth that has 91% employee engagement. Like from my Arthur Andersen background, optimally, we can expect people to be 70 to 80% productive. Now, I know productivity and employee engagement are not necessarily the same thing, but they're close, right? They're an indicator of how people are focusing. So do I believe that they achieve 91% engagement? I don't know, a little hard to believe, but listen, those are their numbers. They survey their employees, whatever methodology they're selecting, that's what they're measuring, and they're measuring it consistently year over year. So do I care that it's 91%? Yeah, maybe, maybe not. But do I care that it's systematically going up year over year? Yeah, that's what I care about. Mm-hmm. So when you say what's employee engagement, you have to go and ask Bank of America or read in their report how they capture this value, employee engagement.
So that could be very different between different companies.
That's right.
Is that going to be standardized as part of this potentially impending requirement for disclosure?
Well, that's a really interesting question. And I think that that's the question that the SEC doesn't want to address, right? They want to address the things that you can count, right? Total cost of workforce, workforce composition, demographics. Attrition and retention is an indicator of employee engagement, because if you're not engaged, you leave your company. When you get into the soft side, and I know, I'm talking as an HR person, most people think that HR is a soft function, but I'm not a soft person. I'm a hard person. I'm a hard numbers person. I'm an analytics person. So when you start talking to me about engagement and you talk to me about culture, the little hairs on the back of my neck start going up a little bit, because it's so hard to capture in a consistent and a universal way what that means, that I would rather see that reflection in direct indicators like attrition and retention, as opposed to indirect or latent variables like employee engagement that are made up of a lot of different things. So I don't know how the SEC is going to handle or is going to address this qualitative indicator of a company's culture, success, or engagement. But we'll see. There are lots of good minds at work on this topic.
But it sounds like we're going to have the need to do another webinar in a year or so and touch on those topics, because it's going to be interesting to see how they evolve. I want to stay true, Solange, to my promise always of being on time and not going over with my webinar. So we're about 2 minutes before the hour right now. Just as a summary, understanding the importance of human capital evaluation elements, knowing what they are and what they mean and what the outcomes of those are. Know what to disclose is another portion of this. And I think the big thing, Solange, that came from you today is knowing what to disclose is changing as we're speaking as well. So we have to stay abreast of those things. And I think this presentation, when you get a copy of this, can kind of be used as a roadmap, or at least that initial view, or the video could be used as an initial view of what to be focused on. Feel free to reach out to Solange or to me if you have questions on these things. And Solange, thank you so much for joining today. Again, we could do 2 or 3 hours on this, I know, but I think it touched on awesome points during our discussion. Thank you, everybody, for joining today. And for those that attended with their International Board Director Competency designation, they will receive their 1 credit for attending today. Solange, thank you so much.
Thank you. Thank you.
Bye
Bye,
now.
everybody.